Welcome to Smart Investing Before the Election, What You Need to Know. You may be surprised to hear this, but I really feel like this conversation is going to be a pep talk for the last few weeks before the 2024 presidential election. We've got about a half a month to go, and I know everyone is thinking, should I be making changes? What could happen? The country's pretty split on who they want to be president, but if you don't get your choice, what should you do? And that's what we're really going to focus on now. And this is taking the place of our typical seasonal investment and economic update because we know the election is on everyone's mind. I am joined by my colleague, Lucy Valandra, and we are going to be telling you all about what you need to be thinking about when it comes to the election. Lucy, welcome to our presentation.
Thank you so much for having me. I'm excited to be here.
I am so glad you're here as well. Okay, let's get started. I just want to tell everybody that is here listening. First of all, you can see our super, perfect faces for a photo shoot plus us in real life. But we want to talk today about why do elections matter and how it matters for your money, the current state of investing in the economy, historical election lessons for investors like you, how to think about investing during the election year, and then your action item list for right now, between now and the end of the year. And then, of course, we're going to keep in mind the most important things for you to remember when it comes to your financial decision making and investment game plan. Lucy and I are both financial planners from Pearl Planning, and we really consider ourselves guides when it comes to helping to people to navigate their financial and investing decisions. So we are thinking in context of your money, but also your life, because I really think it's critical when you make choices about how to invest that you have the right time frame, you have the right circumstances and situations. And so we see ourselves as those guides. And through all of this, I know that with human nature, our strong, strong desire is to have predictions, to know the future, to have a crystal ball. That's what makes us feel comfortable as human beings. And I love this quote from Lisa Feldman Barrett. She says, through prediction and correction, your brain continually creates and revises your mental model of the world. It's a huge ongoing simulation that constructs everything you perceive while determining how you act. And gosh, doesn't that really sum it up when you're trying to figure out what to do both in life as well as with your money? You constantly are trying to figure out in your brain, just naturally, it's a human model, what is coming next. And you feel more comfortable, even if it's really bad news, feeling certain instead of uncertain. And unfortunately, in a world like ours, there's a lot of uncertainty and we can't foretell the future. We can't say who will win, and we also can't say how the markets will react. And so we really want to provide this context for you to know that we tend to build investment strategies and game plans built for a variety of outcomes, just knowing if we had a crystal ball, it still wouldn't make a difference in the future. It's important when you're thinking about your need for that prediction to remember that we are a machine that's built on an evolving organism or creature. Our human history goes back 5.5 million years to our ancestors. And when your ancestors were out in the wilderness trying to survive, it really mattered making the most defensive and correct moves immediately. They were really in an immediate reaction environment. And it's a very short time frame in our history of the world where we sit in these rooms on computers, streaming out via video to people like you on YouTube. It's a very short, even though it feels like a long part of our history, only 50,000 years. And getting it right between that immediate reaction, kind of fight or flight brain setup, or the more delayed return environment that we live in today makes sense on paper, but is very difficult to do as a human. And we keep that in mind when we give you professional advice when it comes to finances and investment management. But that's an explanation of why you always are trying to predict what's going to happen next and decide whether you're under threat. Now let's turn it to what happens during elections. And I want to actually give you a history lesson that I learned myself in preparing for this conversation. The election of 1840 between William Henry Harrison and Martin Van Buren left Mr. Harrison with a problem. He was considered to be too old. In fact, he was the oldest elected president before a recent past. And so someone made an offhand quote that they might as well just put him up on the porch and give him some hard cider to kind of while away the rest of his days instead of electing him to be president. But he also had an image problem. Like many of our presidents, he was kind of born with a silver spoon in his mouth. And so he wasn't kind of a man of the people. And our frontier country back in the day really wanted somebody who was more of a rugged individualist who had made it on their own versus having family wealth and money. So his campaign decided to embrace the hard cider, which was seen as more of an everyman type of consideration. They made his image like he lived in log cabins, and then thus he was trying to steamroll another very wealthy individual, Martin Van Buren. That fast forward to today is kind of what it's all about when it comes to the election. There's a lot of um, defense, there's a lot of smoke and mirrors, there's a lot of attempts to be like everybody else and put your opponent in a negative light, which really makes it difficult to decide what to do long term when it comes to your money. Fortunately, we have data sets going back over presidential elections. And in our conversation today, we're really going to focus on what's happened in more recent elections, kind of the modern time period since the 1950s. But we can tell you what happens, and you may be surprised what typically happens during a presidential election season. Now, why does the election matter to your money to as an investor? Well, of course, we have been told time and time again that it's the economy, stupid. Ever since James Carville gave advice to Bill Clinton to run against George H.W. Bush, that to basically run against him on he was an alternative to a president who happened to be presiding during a recessionary economy. There has been so much focus on the economy. And so not only are investors seeing the results of elections, feeling that that really matters in all aspects of life, especially when it comes to investing in the economy, but that's also what the campaigns hammer down day to day. And so when we look at surveys from investors, and UBS has a great long-term survey asking both higher net worth investors as well as business owners who they like and what they think. You can see, surprisingly, people who invest with money are about half and half, but a little bit tilted when this study was done in late August, early September toward Harris. And then business owners are slightly tilted toward Trump. But everybody thinks the economy really matters when it comes to the election. Um, and they really focus on economic issues, which just amplifies your concern for the outcomes of the election when it comes to decision making on your money. Um, but what we're here to tell you, and we will reinforce this now and in a few minutes as well, is that both parties historically have had solid returns when it came to investing. When you look at the chart on the left, there's a measure of both stock market return as well on the up and down axis, as well as economic growth on the horizontal axis. Ironically, some of the highest growth presidencies, you can see Kennedy and Johnson way out there on the right, didn't necessarily have the market returns that some of the other presidencies had. But nonetheless, when you look kind of across the board, there are two outliers. George W. Bush as well as Nixon, although there were certainly external factors that were not entirely controlled by their presidential decision making that impacted the results when it came to investor results. So regardless of parties, there have been long-term economic growth in many, if not most presidencies, as well as long-term returns in the markets. And you can see how those actual numbers go on the right-hand side image, because there you can see red and blue for, our prescribed, red being GOP, blue being Democrat. You can see the returns of presidents over time. And all things being equal, we'd want to take both of these into consideration. In fact, if you were to just sell your portfolio when the party you don't like is in office, which there's plenty of opportunities to do that over the years, both parties have been in control for sizable periods of time. If you just were only owning during Republican presidencies, you'd only have an annualized return of 2.78% going back to 1950. If you only owned during Democratic administrations, then you would have a 5.2% annualized return. But if you put them all together and were invested entirely throughout time going back to the 1950s, so about 75 years, you would have 8% annualized return. Gosh, I'd sure like to choose to not miss out on the opposing parties. Years in the market when you look at data like this. And of course, future returns are not predicted by what's happened in the past, but that's certainly a powerful data set to consider as you think as to whether or how you want to invest after we know the outcome of November's election. Lucy, tell us what's kind of on the table because I know taxes come up a lot. What are you seeing?
Right. Well, and this plays into the economy so much. And, each party does have a little bit of a different outline of how taxes are going to be treated, should one become the president over the other. On Harris's stance, she is committed to raising corporate taxes, going down from 28% to 21%. Trump, on the other hand, wants to lower them even further down to 15%. So both do want to cut, she wants to raise the taxes and he wants to cut the corporate tax. Personal income wise, there is the sunset currently of the Tax Cut and Jobs Act that Trump enacted. This is going to affect a lot of people. So she would like to revert the top marginal tax bracket up to almost 40%, where Trump would like to make those expiring tax cuts be permanent. On the SALT, which is your state and local taxes, there is currently a $10,000 cap because of the Tax Cut and Jobs Act imposed by Trump. He doesn't have an explicit plan stated, but given what we've learned of late, his economic advisors are kind of imposing any sort of increase on that $10,000 cap. And the Democrats don't currently have any policy stance on that they've outlined at this current time. So we do think, there's not going to be a hard sunset on the Tax Cut and Jobs Act. Again, would love to have a crystal ball to predict the future, but there will be some sort of version of it kind of extending, no matter who wins. But encourage, everyone listening and all voters really to understand these policies that are being outlined by both parties.
Yeah, that's a great summary, Lucy. It's really hard to nail down what the possibilities are. And there's this assumption that any given president can go in and just like wave a magic wand and their tax policy will be immediately enacted. And it's just not the case. There typically has to be agreement and compromise across parts of the government. So the legislative branch and executive branch have to come to agreement. It's unlikely that there is a full sweep with a filibuster-proof Senate. So you're really looking at a place where everybody needs to get on the same page. And because there are major budgetary considerations to keep the government open, that will likely be a forcing mechanism to require compromise. It will be politically risky for both to refuse to cooperate with the other. You typically tend to have to come up with kind of a grand compromise at the very last minute that does not just involve the president saying, here's how it will be, and, kind of send the scrolls down from the mountaintop. One of the interesting things that we're doing for our clients when they have these concerns over taxes is we can actually put into software a typical tax return, anticipate what might be happening in 2026, because the current law, if nothing happens, sunsets at the end of 2025. TBD whether something gets changed beforehand, but an interesting point of reference. But we can then put in your specific circumstances and compare and contrast what your tax rate may be before and after. And depending on the person, for example, if you live in a high tax state or have really high real estate property taxes, you may not be able to itemize today, but you could have under the previous act. You might be better off under a different under the old system versus the new system, kind of using that as a proxy of a potential for Harris versus Trump victory. And so it don't take everything with a grain of salt, and everybody's tax circumstances are different. So some people could benefit from being able to itemize more or specific tax rates, and other people having, for example, a higher child tax credit possibility have advantages there. And so it just depends, and you really need to get specific advice about your situation. But in all circumstances, I think, thinking about the tax decision making that you have is really critical. So let's talk about the investments in the economy today. First, we've been waiting, everyone has, or at least forecasters have, for a recession, recession, recession. And, people have been assuming kind of a consensus is that growth is low and the numbers just keep coming up higher. And so we've got an economy that it would be nearly impossible to say that we're in a recession today. Certainly there are possibilities in the future, but that we were at 3.2% for economic growth this month, and Federal Reserve estimates for the future are even higher. You also have high returns across the board in terms of asset classes. This was taken right at the end of September, and you see that U.S. large company stocks are leading the way, but then also medium and small company and international, as well as bonds, are all making money. Meanwhile, it seems like mortgage rates have topped out and are going lower. We'll see what happens next in terms of interest rates and inflation, and can talk about more on that later. But housing prices remain high, and so that's a challenge for consumers that want to purchase houses. But when you look at what's happening when it comes to what people are taking home, certainly there are pockets of the economy where unemployment is ticking higher. We'll show you that in a moment. But in general, looking at the blue line on the bottom, that's real wages. There is actual growth after inflation when you take a composite of the entire company in terms of what they're earning. So not the worst news in the world. In fact, that's quite good news and kind of back on trend. Meanwhile, there has been a slight uptick in terms of unemployment. It's in the 4% range, but not some numbers keep surprising on the upside, and the unemployment rate in general is well below the 50-year average of 6.2%. Meanwhile, we also have that wage growth more around 4%, which is near its average. So it may feel gloomy where you're sitting, but when you look at the economy on average with long-term numbers that get reported, revised, and are quite predictable, you're seeing that the economy definitely has a heartbeat. Also, a very high discussion is like debt, whether it's federal debt or household debt. And in this case, we want to show you, yes, household debt has been growing. It's a 4% annualized change over the last 10 years. But interestingly, at the same period of time, the US total net worth is higher primarily because of high asset prices, the ability to finance your mortgage at a very low rate. You see a 7% annualized growth, 6.85 over the last 10 years. So the bottom line for consumer households is stronger and is growing faster than the debt in households. So the debt exists, but isn't worst case scenario. Meanwhile, we see on the top, this is the change in consumer prices, 22% higher over a 5-year period. So, $100 that you had 5 years ago feels like $82 today. You can see, though, that that's flattening out, and a lot of people are waiting for prices to go back to where they were. And I just don't think you want that to happen, because deflation typically is in a very bad growth scenario or recessionary environment, very high unemployment. So it's still going to feel like a sting for longer, but what we're seeing is that inflation is much more under control than it was a year or two ago. So Lucy, tell us about historical lessons when it comes, what have you uncovered that people need to know when it comes to elections?
Yeah, and I feel like our compliance team would love us to reiterate, that past performance is not indicative of future results. But I do think, this election is like no other that we've seen, but I do think that it does help provide some sort of comfort too to look at what has happened in the past. And this is a great visualization showing the average S&P 500 performance since 1950, kind of reiterating a chart that Melissa already showed, showing that if it's a pure Democratic president with a pure Democratic Congress, how it has grown versus a divided Congress versus a Republican controlled Senate. And then same thing with the growth with a Republican president. If it's a Democratic Congress, if it's divided, which again is most likely what we're going to see, and then a Republican controlled Congress. And most of the time it has been mixed and it's been up. So historically, the S&P 500 has been up no matter who is president and no matter what the division of Congress looks like, which I think is a nice comfort. And like we've said before, markets just really don't love this uncertainty period that we're in. So regardless of who is going to be controlling the White House starting in 2025, we will hopefully have a definitive answer come November 6th, the day after the election. And then the markets will historically always grow significantly post the election day, no matter whether it becomes a Democrat controlled presidency or the GOP is in power. They just don't like uncertainty. People don't like uncertainty. Markets don't like uncertainty. We like to know what is going to happen and that there's going to be a definitive answer. And so again, this is just reiterating what markets tend to look like the day after election and how much they grow in what we kind of lovingly call a Santa Claus rally, which is very typical with election years of post November election day up and through the president actually being inaugurated into the office. And, there is some volatility, but typically on average since election since 1952, about a 2% positive return. And then you can see down on the bottom with both Trump in 2016 and Biden in 2020, they were both positive. So hopefully that trend continues. And then again, looking at the volatility, the VIX index during election year, the time leading up to election day just skyrockets, right? We are not loving all of this uncertainty. And then as soon as we hit election day, it comes right down and kind of helps to flatten out into inauguration day and kind of levels even post inauguration day for a smoother ride. So leading up from right now at, kind of crunch time to the election, it's going to continue to most likely tick higher. But once that decision is made on our country, and then through inauguration day, the volatility will hopefully level out. So action items that you can do right now. It feels a lot like is going on, but most importantly, get out there and vote. Should you make changes to your portfolio, you want to do something. A lot of people, depending on if their person wins or not, wants to look at specific sectors or flee to all cash. We've seen it all. The most important thing to do from this chart is just keep calm and remain diversified. We preach it again and again and again. So some people would think, okay, if Trump wins, that defense would do better versus if Harris wins. And it was really interesting. We didn't pull the chart here, but there was a historical chart looking at energy and electric vehicle use under the Biden administration versus Trump. And you would have thought that it would have gone up with Biden and down with Trump, given their policies. And it was completely flip-flopped. So there isn't always a rhyme or reason to these specific sectors depending on who is in office. So just another reason that you want to remain diversified. And again, don't let how you feel about whoever is in office or whoever is controlling Congress overrule how you think about investing. This is just showing that if you keep calm, remain diversified, the market historically has gone up, whether it was under the Obama administration, the Trump administration, and the Biden administration. And that election days show these big jumps and volatility, but then it kind of smooths out with both the GOP and Democrats in office.
I think it's so interesting that people really um they immediately think, oh my goodness, like the sky is falling. And if your party isn't in office, this is just a measure of like who hates the world. And it's, if the person if you're a Republican and a Democrat is in office, you think things are pretty bad and vice versa. And the reality is, with the benefit of hindsight, we can tell when the bad times are and when the good times are. It's not very likely that things change on a dime based on the administration, in at least in your day-to-day life, specifically in your investment portfolios. Lucy, I like to say that people are really like, kind of the economy and investments don't really care who's president. And the other thing I like to remind people of is that your time frame for the purpose for most of your investments is much longer than it's a longer than the presidential election cycle. It's longer than 4 or 8 years. You're typically investing for retirement, and you're investing for decades. And so you can really get scrambled if you are reacting to things that are much shorter time period. And I'm talking specifically in the investment and economic world. So here's what we would be focusing on. I would definitely tell, and we will continue to tell people in our year-end webinar that will come out right after the election, you probably need to rebalance if you haven't been actively kind of monitoring and managing your asset allocation. Stocks have had 2 rip-roaring years. So if you didn't do any trading, aren't paying attention to what your mix of stocks and bonds, it could very well be that you have a lot more in stocks or a lot more risk because of for good reasons. The same goes, this chart is looking at growthy companies, like think your technology darlings versus like traditional, more value companies. And growth companies are just so much better. They've had so much better performance that their prices are a lot higher than value companies. And if you think about it, like kind of the AI trends that have really been dominant in technology are going to start filtering into your more traditional companies, and they may get some of those benefits. And so there's a couple reasons to, consider rebalancing, especially because we don't have that crystal ball, even though we would love to. So that definitely would be a reminder. Again, same. You think about making sure that you also own some smaller companies. It can be really tempting to only own the S&P 500. And certainly for much of the last 15 years, that's been a great way to be invested. But there are periods of my career, since I go back about, oh gosh, almost 30 years now, where it really would benefit to own smaller companies, to own a little bit more international. And we have a really concentrated top 10 stocks where they're a lot more expensive because they've done so well, and they're a bigger portion of the index, but their revenues aren't keeping up with their percentages. The top 10 stocks right now are 36% of the entire S&P, and that just isn't what their economic contribution is. It's smaller. So again, you may want to own some mid and smaller companies. These are things we're discussing in our own investment committee. Same goes for international. You may say, why would I own things overseas? There's so many bad things going on all around the world. But the reality is that international investing and having some diversification of currency as well is tried and true method of diversification. And when you look at the rest of the world, they seem to be cheaper. They also have higher dividend yields. So there's a higher portion of return that might be predictable. Bottom line is, don't bail on your strategy. Don't, and especially this is a chart just saying, hey, when inflation has moderated and all of those blue bars are different types of investments, the blue to green bars, things tend to go higher. And so, yes, we have a presidential election year. Yes, there's likely to be a change of office. Yes, it's also true that while people assume that a year like this is a very negative time to be an investor, Presidential election years tend to be a great time to be an investor. This one, even more so than most, at least year to date. But do not bail on your strategy because moderating inflation tends to be good news. Only being in the second year of a bull market also tends to be good news. Bull markets tend to last a lot longer. I would remind you because we are so influenced by streaming, social media, algorithms. This is a study published in the Science magazine that talks about what you read, and there are so few commentators that are making up such a big portion of influencing how people see things that it's almost like you're looking at optical illusions. Do not get distracted or let your money suffer from the whims of bad advice. And so do not rely on headlines or social media for your decisions. We really encourage you to look at more pragmatic, long-term thinking, experienced professional investors. And of course, we're biased, but we love the advice of financial planners. I also thought I would throw this in because there's, a lot of nostalgia, whether you're a Democrat or Republican, for why can't things be more civil? Why can't they be the way things used to be? And on the left is a headline I grabbed from Twitter that says, life really was better 50 years ago. And it just pulls headlines going all the way back to the 1890s, talking about why 50 years ago was better than today. Been there, done that. I'm a kid of the 70s and 80s, and I wish there were better movies than there are today. Why do we have to do just all sequels. Although, I also love when I'm looking forward to the Goonies coming out again. But when you look at the growth story of the US, we don't necessarily want to go back. Our kids hold a thing in their hands that's more powerful than any computer when I was a child. And that nostalgia really has a place, but you also need to recognize the power and the growth story of the US economy, which is not a mirage. And so many good things happen that it may feel depressing, but if you focus on your purpose and your specific circumstances, I think that is much, much more valuable. We can't predict what will happen next. And we love this quote from Dr. Daniel Crosby, a future guest on our podcast. To strive for certainty is to doom oneself to mediocrity. This is just a look, all the red and yellow. The yellow is the average price target for the from the Wall Street Journal's top researchers for where we would be at this point in the year. And the blue is where we actually are at as of 9/24. Trying to forecast means that you're assuring yourself of being wrong. And even though our caveman mind really wants that prediction, it's just not realistic. And I'll pull in, since we're from Michigan, the Tigers. Really think about the world in terms of probabilities. And here's the probability chart of the Tigers making the playoffs. As you can see, that dip to 0.2% as of August 10th. And yet they ended up making the playoffs, 100% probability of making the playoffs by October. Do rely in the world of possibilities and probabilities instead of predictions. And do keep your long-term game plan, just like the Tigers plugged away each at bat to try to make it through. Our world, the world of financial planning, is change management. That's really what we do. And when you look even as far back as Darwin, he said, it is not the strongest of the species that survives, nor the most intelligent. It is the one that is the most adaptable to change. When it comes to the election season, or really any season, any new news, that's the change management that we're trying to instill in you. So do keep with your plan, do keep with your process. And remember to contact us if you have any questions. I will make a special headline note that our Women's Money Wisdom podcast will come out with a special episode on election day that is all about your mindset to take with you through that week. So make sure to tune into that episode. And if you enjoy the podcast, like, follow, subscribe, or leave a review. And then don't hesitate to follow us, whether you found us on YouTube, in our newsletter, or are a long-term friend of the firm. Thank you so much for listening, and feel free to subscribe so that we can stay in touch. Of course, we have our regular disclosures. Lucy, thank you so much for sharing. And we will be doing another video just like this on the other side of the election about the most important things to consider for your financial plan between now and the end of the year. So don't miss that. It's coming in November. Thanks a lot, Lucy.
Looking forward to it.
Okay, have a great day.